Let's welcome Mr. Niraj Singhal, who is a Senior VP and Head International Consulting Entity Data Services, who would be presenting the keynote and discussing around accelerating value creation in BFSI, configuration of people and technology. So Niraj, over to you.
Thank you. Today, I'm going to talk about a very interesting topic, which is value creation in banking, and really what the financial institution of the future should look like, and what are the key disruptors which are disrupting financial services. So this is a very interesting example of one of the oldest banks in the world, Banco Monte di Paschi di Siena, a bank which was founded in 1472, perhaps the oldest surviving bank to date. And what's interesting about this bank was it focused on just two products, which was essentially a current account or a checking account, and also loans. And it was a very product-centric financial institution. So products were the center stage in terms of all their operations. Now, if banks are going to be very product-centric, what prevents Amazon, which is one of the largest product e-tailing companies, to offer financial products and services to the customer? So the real question is, what should a bank of the future look like? And I think the way to really analyze the disruption which has happened in banking and what the future would look like is to go back in history. And I call it the 5 golden eras of financial services. So the first era was really the digitization era, which was converting paper into bits and bytes. And what you see in this figure is one of the oldest mainframe computers in the world. This was the electronic recording machine for accounting. It really automated the bookkeeping and the check processing function. And it went into production in the year 1955. But interestingly, when the entire banking function was put in the computer, the focus still was on the account number. So the identifier tended to be more product-centric, which was really the holy account number. And in many ways, that's even continued till today. So if we leave behind the computerization era, which almost, I would say, lasted for about 40 years, between 1950 till about 1990, the next era was what I call the mobilization era. Now, mobilization takes many forms, but the way I would conceive mobilization is really taking the functionality of the branch and making that reach the customer. So whether it is through the mobile phone, the internet, the contact center, the 24/7 ATM, the functionality pretty much was very branch-centric. So once all this reached the customer, the third was really the optimization era, which also is called the robotization era. And it was really automating key functions of the financial institution to reach economy and scale. So really, we've seen this manifest in many ways, right from straight through processing of payments, where the STP rates have really gone up to almost about 85–90%. Or it is straight through processing in trade transactions, right from placing an order to the time the order is fulfilled, and the automation that's part of that trade life cycle. So once we've more or less optimized and we've got the digitization and the mobilization in place, the next big era, which is quite recent in my view, starting with about 2015 and going beyond, is what I call the intelligentization of banking disciplines. So really getting intelligent machines to start replacing the banking clerk, or what I call them as intelligent men. So the machines were much more intelligent, and this is the first time that the functions shifted from being very product-centric to more customer centric and really modeling the customer behavior to go through the next best action. And now, starting with 2020, the fifth era of financial services is really the equitization era. Now, equitization means three different things in my view. The first thing is really the economics. How do you reduce cost? And now financial three different, how do you reduce customer? The second is all about collaboration. How do you collaborate with your ecosystem? And you don't have to do everything yourself. So you can really use your ecosystem to drive different outcomes for the customer. And then the third one, which is really sustainability. Everyone talks about sustainable finance, but how can you really reach the unbanked, the financial inclusion, and really future-proof your business? So equitization really meant different things for different people. So in terms of the 5 eras of banking, while most financial institutions have gone through this and they are somewhere between robotization, intelligentization, and equitization, this is not enough. And I think the best that exemplifies this is really the what has happened with Encyclopedia Britannica. So very interesting example, a 250-year-old business, which was predominantly 32 volumes of history and scientific knowledge. The last time it went to print was in 2012. And they converted from a print version to a CD, and now they've also got an online version. Contrast that with Wikipedia, which today has 244 million hits every day. Encyclopedia Britannica's got less than 3% of that volume. So I think the name of the game is really changing your business model. It's not enough to just digitize and robotize and intelligentize, but really, reinventing your business model around the needs of the customer and really making this more collaborative with the client and with others. So customers really need banking and not banks. And I think one of the interesting examples of this is what we've seen with Paytm 2016 and beyond in the Indian context. So Paytm really understood the need of the customer and really modeled customer behavior in its transactions. So post the demonetization era in India, when a customer would buy something, Paytm became the de facto choice to make a digital payment. And that was really modeling the entire business around the customer behavior or the need that the customer had. So it really gets us to the point that if other industries are going through all this disruption as a result of digital, the best example that I can think of is Uber, which is today the world's largest taxi company, but it owns no cabs, or Netflix, which has predominantly become the largest entertainment company in the world, yet it has no cables. Why do financial institutions need to be brick and mortar and have branches? What's the future of financial services? Now, to answer this question, I think it's important to realize that the future is now and here, and especially in the Indian context, look at the disruption that's happened just in the last 2 years. So today we've got mobile phones, which have reached almost 86% of the Indian population. We've seen a 72% growth in digital payments just in the last 18 months. There's a lot of innovation which has happened in the Indian market around the unified payment interface. And I would say right from things like the Aadhaar-enabled ATM, which reached cash to a lot of people, especially during and after demonetization, and also really creating an ecosystem with post office, to e-learning platforms which have really mushroomed, and sales of these platforms has gone up by 100% just in the last 8 months. So there's been a lot of disruption, and I think the future is here, and banks need to really embrace this future with open arms. So while all this disruption is happening and financial institutions are trying to become very customer-centric, regulators are also forcing this move. The best example in my mind is what happened in the UK in September 2013. The Financial Conduct Authority introduced a new service which was called the UK Account Switching Service. So just like you have in the Indian context where a client can switch his mobile number from one provider to another, in the UK, you can switch your account number from an HSBC to a Barclays with all the adjoining standing instructions, direct debits and direct credits, and no disruption just in about 7 days. And in order to achieve that, I think there is a lot of optimization that financial institutions need to do. And just take an example of KYC. Today, KYC information not shared within financial institutions. But if you really have to hasten something like this, sharing and collaboration becomes the cornerstone of success. Another interesting regulatory example is the real-time payments wave, which is now hitting most countries. And if you look at the Australian example, Australia spent almost about $10 billion in becoming real-time payments compliant. In fact, even more. But the question was really what was the ROI as a result of all this spending? And one of the interesting financial institutions that we worked with, which has really exemplified the return on investment, is to convert a compliance opportunity into a commercial opportunity. So what they've done is, take the example of a person buying a used car. So you find a seller, you contact the seller, you inspect the used car, you pay the seller through check. The check gets realized in about 3 days' time. And then you take all the documents, you go to the car registry service, you register the car, and post the registry, you actually commute the insurance from the seller to yourself or take a new insurance cover for yourself. And all this takes more than about 7 days. Enter ecosystems and leveraging real-time payments, you can actually do this within minutes. So you have an ecosystem where you can buy a car, you can choose the best car for yourself, make the payment real time. You got the registry service which dials into this, so the transfer also happens real time. And finally, you walk away with the car within an hour or even less. I think the fintech collaboration topic has been talked about for a while now. And the very basic form of fintech collaboration is really using fintechs as a complementary service to expand scope and reach of financial institutions. One of the financial institutions in Europe that we've worked with has used fintechs in a completely different manner. So this financial institution had 60 different correspondent banking relationships, and they would settle in 60 different currencies. But what we interestingly found out was that 3 of the currencies, which is the pound, the euro, and the US dollar, were about 95% of the value. And this financial institution was spending about $20 million in just 5% of value, which is the 57 different correspondent banking relationships. So the question that we really asked ourselves was, what if we transport these 57 different relationships into a fintech like Earthport, which is now used by Visa, which is owned by Visa? And the cost really drastically comes down of maintaining those relationships. So it's also economics, but it's also customer experience and really efficiency of operations. Another example of a financial institution that I've been very closely associated with is Starling Bank, which started in the year 2016. This is a bank which believes in keeping things extremely simple. So it's a single product company. It only owns a current account. It's a single channel financial institution. It only transacts business through the mobile phone. Yet it's become a unicorn in April 2021, just this year. And the customer base has massively grown over the last 3 years. So keeping things simple is not that bad a thing, especially with everything else outsourced. So the card is from MasterCard, the loans are from HSBC and Barclays. Experian does the credit information and credit rating. So the only thing that the bank owns is the customer, and that's the most precious resource for the financial institution. So while we've studied how banks have evolved and how the customer becomes extremely important, it's also useful to give the right advice to the client if you have to keep him. And hyper personalization is a key trend with a lot of financial institutions today. So the key here is to capture the hopes, aspirations, and goals of the client, really know the customer extremely well. Once you know the customer, you then start engaging with the customer in ways that are meaningful for the customer. So really being the trusted advisor for the customer, irrespective of whether you're making profits out of him or not. I think that is the key to sustainability in the financial services paradigm. So while customers are becoming very demanding and financial institutions are trying to woo them, becoming very centric to their needs and hopes, and really making them fulfill their goals. Another example which comes to my mind is that financial institutions also need to be very socially responsive. So if you combine the data that financial institutions have, which could be structured as well as unstructured media with data which is outside the financial institution, combine both of those and really drive next best action through AI, this entire proliferation of chatbots and chatbot banking. That is one aspect of being responsive. The other aspect of being responsive is a lot of financial institutions are now looking at, Alexa and artificial intelligence to really reach people who are not able to remember their account numbers or their passwords. So use voice biometrics, authenticate the customer, interact with the financial institution. Alexa or a chatbot becomes your financial institution, and really make the bank reach the customer's doorstep through commands and instructions through Alexa. So in summary, I think it's extremely important to focus on the 5 pillars of the future. So the first is really institutionalized banking innovation. A lot of financial institutions talk about innovation, but they don't reward their employees and stakeholders for innovating. Fail fast, yet fail often is the mantra for success. So keep the innovation cycle running as far as you're concerned. There's another statistic which actually supports this. It takes less than 6 months for your nearest competitor to come out with a better product or service than what you have. So innovating in an agile manner is extremely important for survival. The second key pillar is personalized customer experience. Again, using data which the financial institution has, but more importantly, combining that the data which is available with the ecosystem and in the internet to drive the next best action for the customer. We've talked a lot about leveraging ecosystems and the fact that you don't have to do everything yourself, to really create that ecosystem where you can reach the customer in a much better manner and elevate the entire experience as far as the customer is concerned. The fourth pillar, which I would in many ways say is the hallmark of success, is to simplify your delivery. Nothing can happen unless you reinvent your business model. Nothing can happen unless you become very customer centric and really model your banking operations based on first principles to the behavior of customers. We've seen that with Starling Bank, which is a single product bank. We've also seen that with Paytm, which really modeled its transactions in line with what the customer wants to do. So that is the key. Changing your business model with changing times is extremely important for success. And finally, future-proof your business. Regulations are going to come. Regulations are going to stay for a while. There are going to be new needs. Customers are going to become more and more demanding. So it's extremely important to have a robust and agile architecture and also to drive your operations in a very sustainable manner. So I think all these pillars are going to be extremely important for a financial institution of the future. Thank you.
Well, finance generally as a topic is considered a little difficult to understand for laymen like me. But thanks to Neeraj, the talk was not just lucid, but it was also very interesting. And thanks so much, Neeraj, for bringing in those day-to-day examples with which we all could connect with. By the way, if you have any plans of becoming a professor in future, please do consider that because it's going to be of huge help to the students community.